Well, if you're as big of a Scott Hansen fan as I am, you're well familiar with the witching hour. And today we have our own version of the witching hour. We won't have any octoboxes. We won't have 7 hours of commercial free football. In fact, this will probably be the most we talk about sports right in this first 30 seconds. But it is a triple witch option expiration day. Could be some increased volatility. We're going to have CC Lagator from OptionsAI to talk about that. We've got some earnings to talk about. FedEx, Lennar's. We've got Nike news. Dennis has a new trade he wants to talk about. Made a new purchase. Excited to discuss that with DDD. So let's go ahead and get pre-market prep started on this Friday, on this Triple Witch. Let's go. Welcome to Benzinga's pre-market prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
All right. Well, as good as yesterday was when we came in and started the show, today, pretty much the exact opposite. Everything is in the red. The S&P 500 down about 0.5%. The Dow down about 0.2%. Your Qs also down about 0.2%. Let's check in on Bitcoin, which got up to around Bitcoin hanging out there, showing some strength against the overall indices this morning. So that's interesting to see the overall market selling off. Bitcoin not as much here. So let's go ahead and bring Dennis in. Dennis, how are you doing this morning on a Friday?
It's witching day, so I'm ready, rearing and getting going. It used to be Ben Lichtenstein and say, he had the 3 R's, like rested, relaxed, and ready to go, he would say. Back in when he was quoting the Spoos. Shout out to Ben. If you're listening today, we love listening to Ben back in the day. He'd quote the S&P futures. But now you love listening to pre-market prep. And there's lots to talk about today. It is witching day. The imbalances for the New York Stock Exchange have already come out. Those stocks that come out at 8 o'clock. And they are mixed and big. So I would expect some big moves here on the opening and potentially on the closing. So now, again, when you look at these imbalances, they change, they flip, they do a lot of funny things, funky things on a Friday expiration of quadruple witch. But one thing we can be certain is that some stocks are going to open up maybe in places where they shouldn't. And that's how I try to take advantage of it. Stock opening too low relative to fair value, I will buy. Stock opening too high relative to fair value, I will short. We're not going to go into a whole lesson on fair value trading. That's for another day. But basically, just simplistically speaking, if the S&P's up, or down 0.16%, some stocks that are opening up here, if they do open up, might be good opportunities to short.
All right, well, let's get into some earnings, some specific company news here this morning, because we will be discussing the triple witch with CC Lagator when he comes on in about 30 minutes. So biggest stock, let's go ahead and start with FedEx here, which for a while was kind of seen as a barometer for the overall market. If FedEx did well, it was seen that, okay, people are buying goods. FedEx is shipping goods. It's good for the economy. And it had a lot of influence over the overall market. It still does, but maybe not as much as it once did, as now, other companies, i.e. Amazon, have taken over a lot of FedEx's market share when it comes to actually shipping goods. Either way, FedEx reported EPS of $3.60, missed the $4.80 estimate, so a pretty big miss there on EPS. And then sales came in at $21.6 billion, missed the $21.95 billion estimate, lowered the fiscal year 2025 guidance. Weaker demand trends FedEx was citing. So again, the overall market not going to like that. The stock for FedEx, the investors aren't going to like that for FedEx's stock, down 13% this morning. We go here, pull up the daily chart here. You can see we're set to open down here at this level, right around $260.
Yeah, I was very nervous about this print. I talked about this on the closing print at 3:30, and people were asking about Lennar and FedEx, the two companies reporting. FedEx I was worried about because I said we've had some hiccups and, obviously retail has struggled. We had a Skechers warning yesterday. There are pockets of this economy that are weakened. And we know FedEx doesn't deliver Amazon packages, haven't for a long time, but they deliver a lot of packages for a lot of other small businesses. And I don't think small business is doing as well as it was 6 months ago. And that's apparent with FedEx here. So FedEx getting absolutely hammered, down 38%. It was also the bar. We talked about this on pre-market prep. It has a higher bar. Gapped up in earnings last time. They're like, oh, the turnaround story, it's doing well. All of a sudden, boom. The gap into a gap area. If Joel was looking at this chart, he'd just be like, holy mackerel. You can see where the clear support is going to be. It's going to be down there at 257. It's going to try to fill this gap. It looks like, down 261. Unbelievable. We're talking about the earnings gap from June when it gapped up from $256 all the way up to $286, $84. So it's trying to fill that gap here this morning. So gaps up, gaps down. You got an island top going on there now. You probably get some support down here, 258 to 257. But this shows cracks again, with mixed messages this market has been, where you've got some companies that are still firing on all cylinders, and you have pockets of this economy that are not doing that well. So, this may be why, Fed's going 50, because they see pockets, they see cracks in the economy here. This is a big crack. And like you were saying, if FedEx was to report this quarter 5 years ago, Amazon would be getting hammered because they obviously delivered a lot of packages for them. You'd see a lot of other stocks getting hammered. It would bring down the overall market. It really didn't do that last night because they don't see FedEx as that big of a concern, especially to our AI economy. They don't see the concern to that at all. But it is concerning when you see FedEx numbers lowering guidance down 13%. I'm very surprised the S&Ps didn't go down further.
Yeah, and I mean FedEx here, we know that the stock can be pretty volatile after earnings. I mean, it's had some big moves here in recent history after earnings reports. What was it? Let's go back here. This bar right here, I want to say was a big earnings miss here in 2022.
They're known for gapping on earnings.
Yeah, down 21% on almost 2 years ago to the day, Friday, September 16th. So now it's Friday, September 20th, and you're looking at down 13%. So FedEx has had these volatile moves before. And yeah, I mean, so part of it is like you said, Dennis, like showing some cracks, showing some weakness. The other part of it is how much of it is company specific, and just the fact that Amazon has continued to take more and more market share. I mean, if you buy you buy a new microwave off Amazon and it gets delivered the next day because you have Amazon Prime, that's one product, that's one box that's not getting shipped through FedEx. And how much of that is happening, throughout the whole economy, where people are just ordering more stuff off Amazon, less stuff through businesses that ship with FedEx. So I'm not ready to, smash the alarm button just because FedEx is had a bad quarter or is lowering their guidance, because again, I don't know how much of it is, company specific versus actual cracks in the economy. And it's going to take some while for that 50 basis point cut to kind of reverberate throughout the economy and pick things back up a little bit. So, you got UPS trading down on this as well, down about 2.3%. So, I mean, UPS's chart and FedEx's chart really don't look that similar. So FedEx has been a lot stronger than UPS.
Yes, it has. And FedEx definitely turned in best of breed here a while ago. And obviously you do trade these two stocks together. I've always pair traded UPS and FedEx together. Other stocks, shippers to think about is XPO Logistics, probably going to be down here today, not as pure a play. Even JB Hunt, I'd be careful on today. No position on any of these stocks, but I expect some weakness in JBHT too off this FedEx report. UPS has been a dog. I honestly think, again, it's not a Tesla show. It's not a Tesla conversation, but you could envision a path 5 years from now where Tesla is doing delivery services too, because they got the semi, working it through PepsiCo. If that works out and they actually get FSD going, all of a sudden, Tesla becomes a delivery service. That's not good news either. So you could see Tesla, I could see Tesla 3 to 5 years from now being a delivery service as well, and coming into the UPS, FedEx, and pissing in their pool too. So I just don't think, I think UPS and FedEx, I think these are value traps. I think they remain value traps. UPS 5% dividend. People say, how do you go wrong? You go wrong when the business isn't doing as good as it was before. We know it. Obviously, Amazon was huge for them for years and years and years. And now Amazon does all their own deliveries. So you don't have, 10%. Like, it's not like, it's like 10 or 11% of all retail commerce, or all commerce altogether is going through Amazon. I don't know how much, online, but it's huge. So I think there's just competition here now, folks, for them. And I just don't see that competition going away anytime soon. So I think FedEx and UPS are both still value traps.
Tesla with a great day yesterday, closing at more than 7%. I was seeing a bunch on Twitter, like, for whatever reason yesterday, a bunch of videos about the electric semis that, PepsiCo, you mentioned, is using. The problem with me and seeing that stuff on Twitter with Tesla is there are so many, like, just Tesla bulls on Twitter that are, so one-sided that it's hard for me to, like, understand, like, okay, is the Tesla semi really this great, or is this just these people on Twitter trying to make it seem so great? Because there's that one guy, what is it, like, Whole Mars blog or something? You know what I'm talking about, Dennis? On Twitter?
No.
Okay,
What is it?
It's like a Twitter account that's like just like Whole Mars blog, and it's just some super big Tesla bull that's like always tweeting. Some real.
There's a lot of Tesla bulls. I'm one of them too. I try to, like, contain myself here, but I'm very excited about this one. I had my buddy text me last night when Tesla had its big move yesterday, and he's like, "We're not big enough in this. We're not big enough." And I'm like, I kind of feel the same way. It's now I've got up to 32% of my kids' RESP. It's 32%. I've never had a stock that big in a single account. Now, again, in its RESP, you can only contribute so much to those a year, so it's not a big deal. But I think it's approaching like 8 or 9% of my overall stock holding. Like, I'm usually 2%, so I'm like 3 or 4 times, what the size I normally am on it. And it's going to be a good one or a bad one. Like, I mean, yesterday my long-term portfolio did really well because Tesla had a really good day. But it really sucks, when Tesla has a really bad day. So it's not going to be an easy hold. It's not going to be like, oh, just, straight up and all, beauty and, we don't have any pain. There's going to be a lot of pain along the way. This FSD is not going to be easy, to get there either. But I think the end result here 5 years from now is going to shock a lot of people. Like, people laughing at Tesla delivery services. I could see the path there. I could see the path there easily if they solve FSD.
Yeah, I just don't know how big the semi, because PepsiCo has had those semi trucks for a while. I don't know. I mean, like, I don't know how many total Tesla semi trucks there are on the road. I don't think it's that many. And so we'll see over the next few years if Tesla develops that. Let's move on from Tesla. Let's go to another earnings stock. We have Lennar. Of course, one of the country's biggest home builders here. So Lennar yesterday reported EPS of $4.26, beat the $3.68 estimate. Sales came in at $9.41 billion, beat the $9.16 billion. You had some disappointing Q4 margin guidance. So the stock actually moved lower despite the double beat. Stock is down about 3.5% yesterday, closed up 2% yesterday. So stock down 3.5% this morning, closed up 2% yesterday. So all in all, pretty flat over the last couple of days for Lennar. You're at all-time highs. But I don't know, Dennis, another report that's showing us maybe a little bit of...
This is a lot different than the FedEx report.
Yeah, because it was just margins.
What's that?
I was saying because it was just margins. It wasn't that, like, the demand.
And it wasn't even anything. It was the fact that home builders have just been ripping, and FedEx was going up too, but this is completely different. This was actually a good quarter. This was actually good numbers here. It's just that everybody, the stock's doubled in a year. I mean, Lennar has just been firing on every cylinder possible, even despite rates being higher. Now, I think this is a dip that does get bought, as opposed to buying the FedEx dip, where I think it's a value trap. Lennar is not a value trap, in my opinion. Lennar is, maybe not a lot of value, but it is. I mean, what's the P on this puppy? Like 10, 11? I mean, this thing keeps going. The multiple doesn't expand, but the earnings keep going up. So the price keeps going up too. I think this is a dip that could potentially get bought here. I'd rather buy the Lennar dip at 3% down than the FedEx dip at 13% down.
I agree with that. I mean, Lennar too. I mean, the home builders, the real estate sector, one of the groups that are set to benefit from these interest rate cuts. Steve in the chat wants to talk about the overall rally yesterday and not individual names.
Sure.
Which I mean, we did cover the rally yesterday before the market
Yeah.
opened. It was everything was in the green. But then yeah, we kept moving. I think we kind of said that on the show that we weren't really expecting the market to just fall off a cliff after. I mean, because look, you had stocks at or near all-time highs, and then you got a rate cut. So that's like, a lot of times that could be, I guess, jet fuel for stocks. And while a lot of people were worried that a 50 basis point cut would signal economic weakness, the reaction yesterday was pretty strong overall. I mean, I don't know what stood out to you, Dennis, yesterday.
I mean, it was an everything rally. Now, again, there was separation, which we talked about and correctly predicted on pre-market prep. The consumer staples would turn red, utility stocks would turn red, and that's exactly what occurred. There was pockets of weakness. IWM gave back like 1% in the first 15 minutes, and Christian was tweeting that and really quickly, but then, turned around and closed near the highs again too. You still got rates going down. And that's still, you got to take it at face value, and that's good for stocks. So I don't totally understand the sell-off, the previous day. Obviously, the big run-up, was helped by overseas markets, but also was helped that people were digesting and saying, look, we got a 50 here. This Fed's serious about, keeping this economy going here. Why are we selling stocks? And they came with their buying shoes on. And where did they go? They really went to, which we correctly predicted as well. We'll pat ourselves on the back here. The AI trade, the tech trade, that's really where they went yesterday. I mean, there were stocks that were just ripping in tech. Salesforce was up like 6 or 7% yesterday. Tesla was up 7% at one point in time yesterday. I think it closed up 6. Microsoft, Apple, a lot of stocks. Apple just having the best day. I mean, and this is one that I've been getting wrong. We pat ourselves on the back on certain places. I have no position or no trade in Apple, but I've been thinking that Apple could weaken, not having it. They are turning it around and saying no, and then it helps, that, Kramer was interviewing, I forget who it was. Was it the CEO? He might have been interviewing the CEO. Somebody from Microsoft, they were talking about, no, it's pretty good. It's, that the first week for iPhone 16 sales were not that bad. So they're kind of saying, whoever reported that, just wasn't correct. So, I mean, you're looking here, Apple just, it was a buying opportunity again, and maybe it's just buying good companies. I don't think Apple's a reasonable valuation, but if they start to get, a growth cycle here happening from, everybody jumping into Apple Intelligence and needing a new phone to do that, that could change the needle and help the E number. And then you look at it at 30 times, maybe it's only 26 times or 25 times, and then it starts to look more reasonable here. So, I mean, tech trade, I think I'm going to keep saying it. I think this year is going to go out the same way it came in, with tech leading the way.
And yeah, I mean, it's just, we mentioned it yesterday too, because when we were talking about the overnight, all the gains come from overnight essentially. And then, I also mentioned the fact that a lot of the gains in the S&P 500, come from holding stocks through some of the best days of the year. And that was yesterday. That was one of those days. And it's like, if you don't own, your Apples, your Teslas or whatever, when they're going up 3, 4, 7% in a day, and you take those days out, then your returns are pretty flat on the year. And that's why, I'm willing to just buy and hold essentially. And you hold through some volatility, you hold through some red days so that you can be invested in the days like yesterday. And, it's kind of fun. Like, I'm like, why not look at my, 401k today? And it was it's
a fun day to look at your long-term account.
Yeah, exactly. And it's like
mine just is ticking up to all-time highs again. It's definitely helped by Tesla, but I really got hammered on that Intel. That really hurt me. There was 2 stocks that just hammered me. It was Intel and it was something else. I can't even remember which it was. But my portfolio really got hit hard. Like when you got a stock and it's 2% of your portfolio, and then it falls like 30%. That's a big ding, or it may have been even 3% of my portfolio. So the Intel fall back in like July was a real kick in the butt for me. And, and I was trying to call a turnaround story, and I got that one wrong, dead wrong. We're going to get some right. We're going to get some wrong. I know nobody on Twitter ever has a losing trade. I have losing trades. I have them all the time. It sucks when your stock gap's down 30% because you can't even really control the risk. I mean, maybe I shouldn't have held it through an earnings report, but I didn't think the earnings report was going to be that bad. It was going to fall 30%. So, you know, obviously wrong. Why? And how do you know you're wrong? You lose the money. That's how you know you're wrong. You know you're wrong when your P&L is going the wrong way. You're wrong. So maybe it's going to turn around. You'll eventually be right. But at that moment in time, when your P&L is going down, you are wrong. Lots to chew on. But I mean, it's been a battle back for my long-term portfolio. Obviously, you know, I'm only long stocks there. Moves with the S&P overall. S&P just started making new highs here again the last couple days. So overall, if you charted my long-term portfolio, you know, against the S&P, you know, there's going to be a lot of similarities there as stocks go up because it's long only. My trading account completely different. My trading account has no charting pattern with the S&P whatsoever. It actually does better when the stocks go down because there's more opportunity, there's more inefficiencies, you know, and that's the trading aspect of it. That's my business. So my P&L and my trading account just usually just continues to drift higher. Has some bad days, but overall continues to drift higher because I'm taking advantage of market inefficiencies and taking little opportunities and, you know, taking advantage of headline trading as well. Lots of different ways to trade. Really, I feel like there's only a few good ways to invest, and that's buying good companies, reasonable valuations.
Our chat keep holding us accountable here, Dennis. They never forget anything. Gabe is asking, you know, you previously called for a top in Nvidia and other AI stocks for the year. Do you still think so, or have you changed your mind?
Well, no, I've been right on the Nvidia. It was 140. I called it right up there. And that's when I had sold some of my Nvidia too. Like I'd sold at 130 multiple times. And I said after, I think it was like June, right after the key reversal day, when it went from 140 down to 130, I said, I think we just seen the top for the year. I think we might still have seen the top. Nvidia's got a lot of work to get back to that 141 by the end of the year. So I'm probably sticking with that. But does that mean I still have a little piece of Nvidia? Does that mean tech can't work here? I think just Nvidia got overheated. I think there's so many pockets of tech that actually have been oversold and could work really well here going forward. I mean, look at a stock like Qualcomm that has just been absolutely hammered. I mean, it's starting to look productive, starting to climb up, starting to look a little bit different there. They don't all look like Oracle, folks. I mean, and Oracle's just been its own animal there, trading up $10 on 20, 30 earnings and just, craziness going on over there. But there's a lot of tech that has been very weak. I mean, Tesla's been very weak too, really, and people pointing out over 3 years, it's down. It hasn't just been this killer stock just going, places. Microsoft's been trying to crawl its way back. But, there's been a lot of weakness here. And it's just because the QQQ, is trying to get up there and trying to approach. And we're still $20 all-time highs here. That doesn't mean, we're just going to have an easy sled and it's going to go straight back there. I think there's going to be some work to do. But I do think story drives price. And still the sexy story is the AI story that doesn't go away.
Yeah, and Gabe clarified, and he said I wasn't suggesting DDD was wrong. I was also kind of curious about that too. If you were 140, if that was still if you were still under.
I still have a lot. I still have quite a bit of cash, more cash than I would like. I got my kids pretty much fully invested. My wife's RESP is pretty much fully invested. I've been sitting with some cash because I'm just on the fence, and I've always got cash. And one thing is cash has been paying. So I've got to kind of move some of that cash back in to the market because I locked some of my, I run like a portfolio where it's somewhat conservative. I'm not 20 years old. I'm not 30 years old. I'm 48 years old. I'm like 10, 12 years probably, away from, maybe I'll always trade a little bit. I'll probably never retire, but, reasonably here, like Freedom 55 would only be 7 years away from me. I don't think that's the case, but I'm not in a position where I can just lose my entire investment portfolio anymore. I've seen that happen. NASDAQ went down 81% in 2002. From peak of 2000, March 2000 to 2002, the NASDAQ went from 5,100 to 1,100. It went down 81%, the index. It can happen, folks. I'm not saying that's going to happen. But, and then I watched the financial crisis. Stocks fell 65% during the financial crisis. So it seems like every decade to 15 to 20 years, we get these vicious 50% corrections in the overall market. And valuations overall just aren't cheap here. So it's not like, there's a reason Buffett's holding so much cash. The same reason that I'm holding a lot of cash too, because I don't feel like we're in this environment here. I don't think there's a crash coming anytime soon. I'm still trading from the long side, but I don't feel like it's all just cheap out here. Stuff is expensive. So that makes me hold more cash. If stocks were trading down at PEs of 12, 13, 14, the S&P, and we were at historically, low PE levels for the markets, I'd probably be a lot more invested right now, but I'm not. So because I just don't think stocks are cheap. I buy good companies, reasonable valuations. Well, nothing's that reasonable right now. So I have pockets of risk where I've put on, which probably keep my company performing because the stuff that I have like Nvidia and Tesla is really high beta. So I have to consider about the balancing act to a certain extent there too. I just don't want all high beta names and the market goes down 1%, I lose 4% those days. I don't want that either. It's a balancing act and it's knowing yourself. If I was 25 years old, I'd probably be all in. Like my kids are ESP. So because they're young, they're 7 and 10. Obviously, we're going to use this money for when they go to school in 10 to 12 years. So, but I've got them AMD, Nvidia, Tesla, AVAV, which is the drone company, and there's like a couple other things in there, like pretty heavy. Like they move. Like that portfolio has twice the beta that my own personal portfolio has. But you're trying to build something for education, and heck, if it went to zero, I'd just pay for their education anyways out of a normal thing. But you're having a little bit of fun with that account, and it moves a lot more. I mean, it's 33% Tesla. It had a really good day.
Yeah, I mean, going back to Nvidia real quick, it's you're what, $23 off off the all-time high. We've seen Nvidia move before. It could get there in a week. It could also go down to $90 in a week. Like we've seen Nvidia move. It could go either way.
I think we've seen. I'll say this. I think we've seen the high for the year, and I think August 5th. It's not going back to 91 anytime soon, unless something crazy geopolitical happens, like macro happens here. I don't see us falling out of bed here either. We're coming into, yes, October is historically, but September is historically a bad month too. You get to November and people just start thinking about like buying things again and Santa Claus coming to town. I mean, we get through the next 4 weeks or so and stocks start to look a lot better here. And with the Fed, the path that the Fed is making here, it's hard to be bearish stocks. So even though I'm holding some cash in my long-term portfolio, I'm bullish stocks here still right now. I don't see any reason to like just turn around and sell everything. It's over. The game's over. Back in June, it was nerve-wracking because Nvidia went from 90. We just had upside capitulation happening in so many tech names. And this is the cooling period, folks. This is the period that you use to buy good companies, that maybe have come down to reasonable valuations. Like Dell. I was talking about Dell before, and it's starting to perk up here too. I don't know if I'm coming in here at 117. It was $100 a week ago or 2 weeks ago. But I mean, just have your list, have your shopping list, because there is opportunities and we do get more opportunities. There's no reason, no need to chase up yesterday when we're ripping higher. They're not the days I'm chasing stocks.
Ack in the chat asking about August 5th. That was the yen carry trade unwind. I think it was a Monday. We came into the office. Everything was down. I think the overall market was down like 2.5%, 3% on open. It looked like the world was ending. And then as
turned around on a dime,
the market closed green for the week after that. So the VIX went up like a bunch and everything was down. And then by the next day, by Wednesday, by Thursday, we were back in the green. All right, some other individual headlines before we get to CC Lagator. That's the second time I mentioned his name. He said I got to say it 3 times before he shows up. Let's go to Nike real quick, which had a big day yesterday. Of course, announced a new CEO. Stock closed up, or no, was this after the close?
Yeah, it happened about, I'd say like 4:15, just after the close.
Oh my God, I have no sense of time. I would if you would have asked me, I would have said that happened at noon yesterday.
No, it was just after the close, and it started ripping, and I saw, and the algos just are all over it, and they're just start buying 82, 83, 84, 85. I was like, look at my Benzinga Pro, and I see the drop, the news drop there, and then I click into it. And I don't know all the details, but I guess the CEO before, he was really good. So this is
Elliot Hill.
Yeah, if you follow the Nike story really closely, this was the one I think that brought. Did he bring Jordan and like everyone, or Tiger Woods? Like
they make it sound so easy. Go find another Michael Jordan and another Tiger Woods. They're all over the place, I'm sure. So replacing Donahue, John Donahoe as the CEO. I mean, the stock went up 7% after hours. It's an $120 billion company. So what? 7% of that's like about $10 billion of market cap gain by announcing a new CEO. I kind of have a theory on this, Dennis, where like, you know, you looked at the move after Starbucks snagged Brian Nickel from Chipotle and the stock went up like $10 billion. I don't think you could really convince me that, you know, changing CEOs adds that much value to your company overnight, no matter how great they are when you're talking about, you know, $10 billion moves. I think a lot of times, or I think in both of these instances, Starbucks and Nike, these are like, you know, very well recognized brands where the stock has been going down. And it's kind of like a catalyst that sparks this buying opportunity, but almost as if like investors were looking for an excuse to buy the dip on these companies. Okay, now you got the new
They
CEO.
were.
Okay, now's the time to buy it because they made some change. I don't think it's really that this specific CEO adds that much. I think people are ready to buy the dip on Nike. And Nike had already started kind of perking up before that announcement. You look on August, in mid-August, it got down to $70 flat, gapped up to around $83, $84. And then you announced the new CEO, and now it's trading at closer to $90. So if you were buying Nike here, you know, when it looked terrible down a couple weeks ago, you've been rewarded.
Yeah, you have. And I mean, but you know, the people who were buying Nike at 120 when they thought it was the dip and looked terrible were not rewarded. So I mean, obviously the stock was 179. So it looked cheap at 120, looked cheap at 100, looked cheap at 80, and just kept going lower. Well, now it's bounced back, you know, and every dog has its day. Bar is like super low, so they just want change. They don't want to see this thing. The one thing about Nike is the stock is not cheap. The earnings have come down so far. It's been such a value trap that the EPS has been coming down. The earnings itself have been coming down as well. So even despite the share price going lower, that PE has not come much lower because the earnings for Nike have just tracked so much lower. I still think it's more of a value trap, folks. I'm not jumping in Nike and getting all excited for a new CEO. I think there's a lot of issues here. I think there's a lot of competition here. You know, my friend Jeff overseas saying everybody's wearing on Skechers, which maybe they're not wearing Skechers so much as another part of the story, but there's competition all over the place here. And on is major competition for them as well. So I think that's the issue for me, is that there's too much competition here. And I don't see any AI story whatsoever in Nike.
Yeah, I mean that's the Nike thing. The competition is what kind of scares me here. I mean, I do love
Big
Nike.
time.
Most of my shoes are Nike. I go for Nike with for a lot of things, but you know, a lot of competition there. All right, some other we'll do one more individual.
They're asking before you go, they just asking about, so 2 minutes before CC comes on here. I did take a new position yesterday. I tweeted it out as soon as I took it because I know some people like to follow my long-term position. So I put this in my long-term account, and it is a speculative play. And if you're following me on Twitter or listen to the closing print, you already know it's Intuitive Machines. I bought LUNR in my long-term account. And I did some research, you know, looking at it. I had bought it, you know, originally on the headline as best as I could because the algos took all the easy money. You know, I had to take the tough money, paying up $1 for the thing off the headline. And, you know, I did a pretty good trade on it that night that they had the NASA contract, the $4.82 billion contract. Well, looking at it, you know, and looking at it from valuation standpoint, this company I bought yesterday, I think I paid $7.67. So I didn't get the absolutely low yesterday, but I did pretty good. I'm already up like, I don't know, 18, 19% on this position in one day.
There you go.
I wish they'd all work like that. I wish they'd all work like that, but they don't. But the reasoning here for my thought process is, one, it's a cool story. Two is they actually, you know, are going to be going back, you know, and to more emissions here. I believe in January 2025, planning another mission, which is only 4 months out. You can correct me if I'm wrong on that. But three is this contract is huge. And I mean, it is over 10 years. It is, you know, they have to hit this target to get the next piece of money. So it's like giving them money. But I mean, this could finance their operations. They get that, you know, hit that target, get, you know, a little bit of money from NASA, finance the next part of it. I mean, this actually could see a path where this valuation could go from 1 billion to 2 billion to 3 billion if, you know, they can continue to get more NASA contracts even after this one. But, you know, there's a lot of work to do. Obviously, this is missions. The missions could fail. There's all kinds of things that could go wrong here. That's why it's speculative capital only. But you could see a path where this could actually maybe eventually lead to profitability for the company. And actually the valuation, I don't think is insane if you were thinking about, just from a revenue standpoint, if they can actually hit these targets and get some of this NASA revenue from this contract.
There you go. I like it. I like the speculative plays. You're taking a stab here. I mean, the stock, as we're looking at the 5-minute chart here, has gone from $5, obviously spiked up on that news, and then you had a little bit of a sell-off. You bought the dip, and now we're back there. I mean,
I bought the dip on. I feel like this is actually turning. This is not a good company, not a reasonable valuation. It's a spec. And I think in everybody's portfolio, we're going to bring CC on here in just 1 minute, but in everybody's long-term portfolio, I think there's a place for speculation, whether that's 5% of the portfolio, 10% of the portfolio, maybe it's 20% of the portfolio, but depending on your age, but there's always a place for speculation. This is in that speculative group where you got a company that's probably not going to make money for a very long time, but they just got a big contract. It's got a cool story, and it pulled back. Like, I think the initial spike was, there because of the contract. And then you get the natural dip afterwards because everybody who's positioned ahead of that news is like, oh, this is my payday. And they're selling. Well, once you get those hands out, there's new hands coming in. And now all of a sudden you got new hands in there where they maybe hold a little bit better. And you can see a path where the stock could go to $10, $15, $20. I don't think it's going there next week. But I think, there's a path here where the stock is not done going higher. I feel like the stock's not done going higher. I may be wrong. Maybe I'm going to lose my speculative money on this. I didn't put a lot of money into it. I think I put 1% of my long-term portfolio into it, so it's a small position. Like, obviously, I usually start at 2, but it's a spec, so I only put 1. Wish I would have put 2. Would have been a lot better. Let's bring CC on here.
Let's do it. It is a triple quad witch, whatever you want to call it, day, which means it's time to bring on our man, CC Lagator, OptionsAI. We see him hanging out in the background. Let's give him our special pre-market prep welcome and bring CC back on the show. All right, CC Lagator, how are you doing this morning? Welcome back to Benzinga's pre-market prep.
Good. I'm doing well. Good to see you guys.
We love having you on options expiration day because this is in your wheelhouse here. And we know there is violent moves related to options, sometimes on these triple witch, call a quadruple witch, whatever you want. Some people will absolutely refuse, like Joel, to call a quadruple witch, but we call it triple witch. I mean, one, just explain, what exactly triple witching is to our audience who haven't heard it. We titled the show Witching Day, so maybe we'll take a chance where our options expert can explain that a little bit. And then 2, explain how maybe you approach a day like this.
Yeah. So triple witching, I always refer to it as triple witching. That's what it used to be called. They tried to make quad witching a thing, but the 4th product isn't very popular, right? It was single stock futures, right?
Yes.
So basically what it refers to is, happens 4 times a year where a bunch of the expirations and settlements all happen on the same day, right? And they tend to be that day itself, the witching term comes from like kind of the weirdness you see, right? And you mentioned it earlier, Dennis, like the open is weird. You might see some like imbalances that you wouldn't have seen on a normal day on the open. And then you have this kind of, the unwind starts a couple of days before, but it really accelerates into the close. And that's a lot of traders and big hedge funds and, mutual funds rolling options positions and things into the next month. And you see a bunch of weirdness. You see whatever environment in the options backdrop that existed that week starts to switch over and you get a completely new one next week, right? And then I think on top of that, I think there's an S&P rebalance, at the close. So you see that after hours, that 15 minutes can be really weird at the close. And then of course that last hour is very weird. So, as a trader, you have to be careful, or maybe even like the way you said it earlier, Dennis, you look for some opportunities on the open, or you look for some weirdness into the close where you might not have seen that otherwise. But from a bigger picture, kind of, looking ahead the next couple of weeks, looking into year end, the bigger news story with a big expiration like this, and this one's massive, and it's one of the biggest you will see. Basically, to put it into kind of the backdrop of options in the market terms, about a third of the options positions that exist and the effect of those options positions goes away into Monday morning, right? So, that backdrop changes Monday morning, and next week historically is a terrible week, going back decades. And the week after September expiration and that triple quad witching expiration, I think it's only been up a handful of times in the last, like 30 years or something like that. So it's historically, we always talk about September and October being historically weak. A lot of it has to do with this. And I could go on forever about this, but if you think about summer trading and summer volatility and low market volatility, we of course saw August volatility, but people start to position ahead of time and they look out to like September options and October options. And this year you throw in an election into that mix too, right? So people start to position for potential volatility into the fall. On top of that, this week we had a FOMC meeting right into this expiration. So you think about all of that option positioning into that FOMC meeting and into this expiration. And it even explains a little bit of the rally yesterday. I think I put something in the chat, like remind me to talk about this a little bit, because on that question on the rally yesterday,
sure,
going into the FOMC meeting, so the way the options complex generally looks in the big ETFs and the indices and things is people buy puts lower than where the stock is trading, lower where the indices are trading, and they sell calls above where the indices are trading. It's one giant moving collar generally, right? And a collar is, if you wanted to collar a stock that you owned, you'd sell an upside call and you'd buy it. You'd use the proceeds to buy a downside put, right? So imagine all of that with all that volatility we saw over the last month going into this FOMC meeting where it was a coin flip what they were going to do, right? Like it was 25, 50, like nobody really knew.
Yeah.
Imagine all of that position. Okay. So now you get the initial reaction on the FOMC day, which was, a little bit weak, but not anything horrible. Then the next morning we gap higher, right? That is a lot of people saying, all right, well, we didn't get this panic sell-off on the FOMC meeting. I'm unwinding all of my protective puts and I'm going to start rolling my upside calls out, maybe to the next expiration or anything like that. And so all of that backdrop in the options market and a lot of that rally yesterday is a lot of people just basically getting out of their protective positions into the FOMC. And that puts upward buying pressure on the market on a day like yesterday. It's like all those market makers, my old job, I'm having a bunch of people sell puts back to me, right? And they're buying the calls back that I was long, right? And so it's sort of like, it kind of puts all this like, pressure, upward pressure on the market out of nowhere.
So you're saying next week, though, all that upward pressure out of nowhere is gone. So we start with a clear slate here. So that opens it up a little bit.
Exactly. And that's generally why, next week, again, that historical record is really a negative one. That's not necessarily what will happen. I think the way you just phrased it is the perfect way to phrase it. It just opens it up. We could see a bunch of people come in on Monday and be like, I think we're going to break out new highs and everything like that. And then the options resistance of all of those upside calls that everyone has sold, a third of them don't exist like they did yesterday. You know what I mean? So you could do the opposite. Now, generally, opening up in fall, we've got an election coming up, all that stuff, right? And we're at all-time highs. Like, that generally historically could mean downward volatility, but it's not guaranteed. It could mean upward volatility, but we're likely to see some volatility next week. And then, to be honest, there's no real reason in sort of the VIX futures curve and the options complex in general is pretty much predicting not super high volatility, because the VIX, you can see it at 16 right now. It's not high. But the VIX futures have been bid up, and options have been bid up into the election for months now, going back to the spring almost. So that kind of environment and that kind of backdrop is likely to continue. Where it might be two-way volatility, and it might be a really tradable market over the next month and a half.
Okay, so let's just take it to what I'm seeing here this morning. I kind of want to understand maybe a little bit too, is like a lot of buy imbalances here this morning. And, I don't know if you've got color on this because this is in the equities here, but, we're seeing the S&P start to come higher here too. Why is it that we see big action on the open sometimes and not necessarily the close? I've always wondered this, where action options expiration day, it's a lot of times off the open, you see some really wicked moves, and sometimes the close is crickets. You'd think with all these options expiring, it's usually on the Friday, the close. So you'd think there'd be more action on the close than the open. But a lot of times it's opposite, where you see huge moves on the open. Is there a market maker reason for that?
Yes. And so there's a couple. And one is on the triple witching day, there actually are, like the AM expiries and all. But the bigger factor is the acceleration of the Greeks into the expiration, right? So if you picture a bunch of calls existing in a stock or a bunch of puts existing near to where the stock is trading, last night or a week ago, those might have been 60 deltas, right? And then 2 days ago, they were 75 deltas. And last night they were 80. This morning they might be 99 deltas, right? And so what's happening is all of that, like what makes an option, which is that time value, all of that stuff accelerates into expiration. So what you're seeing in a lot of cases is you see this odd $2 gap higher in $100, and $50 stock. It might be going towards a strike or away from a strike. And it's basically all of that option theta decay. And, options either go to 0 deltas or 100 when they expire. And that is not linear and accelerates into that Friday expiration. And so a lot of times you're probably seeing that in the morning. And in my old job, what would happen is you have this massive portfolio of 200 stocks you make markets in, right? You leave Thursday evening with a certain risk profile of here's my Vega, here's my Gamma, here's my Delta, et cetera, right? Because it's the only way you can kind of comprehend that many positions. And you see your risks, like if the market opens up 1% tomorrow morning, I lose X. If it opens down 1%, I make X, or vice versa. And you come in the next morning, and without having happened in the market, all of those risk parameters have changed just because you've had 12 hours of time in the options in your positions. So you thought you were flat yesterday at the close. You come in this morning and you are short 100,000 deltas, and you need to buy 100,000 shares across your portfolio to even out, to get back to delta neutral. And so you're seeing that kind of, this is super nerdy stuff, but
this is really good because, I'm an equities trader, not an options specialist. And I was never an options market maker or anything like that. So it's really good to understand. I've never understood like these huge buyers that come on the open. Like I've assumed it's because of the options, but just, to get like the reasoning behind it adds so much color for me and for our audience.
And just in general, not to be like a market maker defender or fanboy or whatever, but there's always like conspiracy talk about like, market makers manipulating, or they want this to happen, or they're going to make sure that this happens. In general, it's so much more defensive. Is they can make money without conspiracy, put it that way.
Minimizing risk.
They're minimizing risk is their job. They're minimizing risk so that they can so that they don't blow the advantages they have. And the advantages they have are everybody trading on their bid and their offer, the fact that they can get short volatility when the VIX is 30 and they have unlimited money to do so, And then they can get long volatility when the VIX is 12 and they have unlimited money to do so, right? They make day-to-day stuff. They're just trying to like not mess it up. You know what I mean? And so that's an example of that, is they come in short 100,000, the equivalent of 100,000 shares. They didn't want to be short the market. They don't care, right? So they have to buy that on the open or even pre-market. And you see a lot of weirdness after hours for the same reasons, is that they, you know, a stock goes up above a strike. That's them hammering it back below that strike. That's not manipulation. That's that they just suddenly inherited an extra 50,000 deltas that they didn't have below that strike.
What about the VIX, CC? Because we saw the VIX spike up, you know, tremendously on August 5th when we had that yen carry trade unwind, and then since then has started to come down. But the other day when you had, I forget what day it was it, I think a day last week where the S&P was down like 1% and then ended up closing up on the day 1.5%, like it had a 2.5% intraday move, which is, you know, pretty big for the SPY. Like, what's going on with the VIX right now?
Yeah, well, it's not that high right now. So, you know, we're at 16 something, I believe. And that is probably a little higher than it normally would be. If this was July and we were at all-time highs, the VIX would probably be 13. So you're getting a couple extra points with what just recently happened, plus going into the fall and an election and everything like that. But it is still low. Like historically, the mean in the VIX is, you know, closer to 19. So that's sort of the overall perspective of the VIX. It's not dirt cheap, but it's not expensive, and it's not even, you know, its historical mean. The way it is pricing things right now is you're probably not going to see it much lower than now, right? And from a trading perspective, if you were looking at out the next month and a half on any sort of positionings for breakouts or for hedges or things like that, you know, you could be buying at the money or near the money options without much of a worry for volatility going much lower than here. Like I could maybe, if we went higher and broke out new highs next week, you know, maybe the VIX is 15, but you're not seeing it 12 anytime soon. Probably not till Christmas, right? And so, you know, you kind of have that, you know, backdrop and backstop, I should say, of if you were buying at the money options right here. And what I would say though is that there are still, we've talked about skew on prior appearances, and what that means is, you know, the VIX is kind of pricing in at the money options and slightly in the money and out of the money options, and it's going out about a month, right? But you see a little bit of a different situation. If you were just buying at the money options in SPX or SPY or Q, it's actually quite low right now. But if you were buying out of the money puts or even some out of the money calls in certain stocks, they're bid much higher. They're much more expensive. And so from a trading perspective over the next month and a half, you know, at least until October and November expiries, let's say, and just using kind of, you know, Dennis, you were talking about Lunar earlier. Yeah. And I actually saw you mention that yesterday, and I pulled up the options. They're kind of interesting. They're very illiquid, so I wouldn't, you know, you have to be careful in a stock like that with options because the bid asks are super wide and everything. But in that case, you know, you've gotten this move, right? That, you know, it was up, what, 20% yesterday or something like that. And, you know, the story is still at play. Like maybe if you were just trading the equity, you wait for it to come back. But if you were kind of like, all right, well, I don't want to miss this, and I think it could go to 14, 15, something like that. In the options market is sort of rewarding you for not being stupid and like buying the 14 or 15 call. You want other people to buy that call. You want to buy the 9 call or the 10 call, and then you want to sell the 14 or 15 call, right? And so when I looked it up yesterday, when you were doing the, you know, the 3:30 p.m. show, if you bought it, and it would be the same this morning. I don't think the stocks moved that much. If you bought the 9 call and sold the 14 call, you're basically buying the 9 call for like $1.50, and then you're selling the 14 call for 50 cents. And so you're doing a trade like that for $1, and you can make up to
That sounds
$4.
awesome. That sounds
Yeah.
awesome.
And you're going out like a month, like out into October expiration, right? So
Yeah.
so you're being rewarded for not doing the dumb, really far out of the money option. You're being rewarded for buying the 9 call and selling to those people, on that other strike. And basically you're getting that 4-to-1 potential payout if you get your move even higher, but you're only risking 1 rather than stepping in to a stock that's already up 20% yesterday,
Yeah,
right?
great point.
Where you're kind of nervous. And so that's one way I always like to think about like spreads and things like that is like, how do I risk the least amount of money, not miss this, but at the same time, if I'm wrong and this thing goes back to 8, right? Like, it's not the worst thing in the world. So.
All right. Well, Cece, we love bringing you on these, triple witching days, and you always got some great information. Give us some insights into the options market. Hope you enjoy the rest of your Friday. Have a great weekend, and we'll be bringing you back on soon.
Excellent. See you guys.
See you, Cece. All righty, yo. We have about 5 minutes left. Some other
They're
news
talking the CEG. We got to talk the CEG deal, which we haven't yet. It's up 24 points. The stock is close, if not quite back to where it was in May, but getting up there here and now. A big comeback story, obviously, from where it was down on August the 5th to $155. It's up 80 points since then. Give us the headline here. It's a deal with Microsoft.
Yeah, and this, by the way, Kramer was calling this one out recently. So we rip on Kramer when he's wrong. You got to give him some credit when he's
liked
right.
The stock for a while, yes.
Yeah. So Constellation Energy shares are trading higher after the company announced it signed a 20-year power purchase agreement with Microsoft. So strategic clean energy initiatives with Microsoft. And you got to think this is good news for the overall nuclear industry here, Dennis. And I mean, you've seen some other nuclear names heating up, and Constellation Energy here now up another $25, closed up 4% yesterday, up another 12% today. So some big moves here in Constellation.
It's a huge move for CEG. Not sure I'm chasing that move. You're actually seeing sympathy moves across the board. Vistra VST is trading up almost $5 on this, which is a big move. Your uranium stocks are trading higher on this as well. Quadruple U is up 5%. It's only a $5 stock. If you like looking at uranium itself, URA is up 3.5%. Canadian Cameco is up 5.7%. That's symbol CCJ. I trade that one all the time. It's a fun one to trade, probably because it's Canadian, so I like it as well. Uranium perking up here too. Does this kickstart these stocks and get them started again? Probably. Dips probably get bought here too. I can't chase a stock like CEG up 25 points on this, even though it's a Microsoft deal and it's a huge deal for them, 20-year. Great news for the company here, but I'm just don't buy stocks that are up 25 points.
Yeah, and I mean, we talked about solar heating up with the interest rate cuts, and those kind of have been your laggards. But if I were investing, putting a lot of my money into clean energy right now, I do like the nuclear space. I think it's just a matter of time before people start, becoming more open to it again. I think it's proven to be some of the most effective clean energy, and if done properly, some of the safest and some of the most environmentally friendly. And so, you look at countries like France that had a bunch of nuclear energy. And then when the whole Russia-Ukraine war started and everyone was, getting hammered because oil prices were going crazy, all the exports from Russia, and France was doing okay. And then you compared their situation to a situation like Germany, where Germany had shut down basically all of their nuclear, and they were in very vastly different situations because of that. So I think, even internationally here, I think over time, I'm not saying overnight we're going to see everyone adopting nuclear, but I think as I grow older, it'll become more and more prevalent. That's just my prediction. So I do like a lot of
energy needs are not going away here, folks. And it's only going, if we're going into this AI economy, energy needs are going to go, even increasingly high. So I think, a lot of these stocks on pullbacks are probably buys.
Yeah, and I mean, in Illinois, I was over there in south of Chicago suburbs, Joliet. They had a nuclear power plant that was like supposed to be decommissioned, and the whole community, like there was a lot of people that worked there that, basically fought to keep it open. And so I was like following that story when it happened. So lots of interesting things happening in the nuclear space, I would say. And this is, again, good news for the overall industry, good news for Constellation Energy. Big move there. Other headlines, just because we only have a minute left.
I'd rather talk options expirations as opposed to individual stories here, because these buy imbalances are just enormous. And the S&P was down significantly this morning, down as much as $1.50. Is ex dividend, if you're looking at SPY, I believe is $1.74. So if you're not looking at S&P futures, the close on SPY 270.98. The adjusted close 569.23. So we're actually down only 30 cents. We're not down $2 like some people, if you're just looking at SPY, might think we are. The buy imbalances are huge across the board. They're all buy imbalances this morning. It has driven the S&P up over the course of the last hour here since these buy imbalances came out. Again, things can change. They could flip to sells. We get a little color from CC on why this happens, where maybe, they have options market makers who were hedged last night or not hedged. All of a sudden, they need to buy more stock to get hedged. And that's what they're doing. They're coming in and buying more stock here this morning, but they are buying viciously here across the board. Again, if you're looking at the stocks, you're saying, what are you talking about, Dennis? Their S&P's trading down. I don't see any vicious buying. Well, we've been going up here because these buy imbalances are orders that are geared for the open. They aren't active in the pre-market. So we're looking at order flow that is going to activate at 9:30. And right now, if these orders stay this way, and again, things can change, and it just changed a little bit. They're still buying balances, but they just went down significantly. Why you see the S&Ps fall. So, I mean, S&P futures completely on options expiration day are driven by imbalances on the equities. So, and if you see, we just fell 15, 20 cents because the buy imbalances just got cut in half. So some probably traders come in and said, you want to buy them up here? We'll sell them to you. So now things have changed. Now they just flipped. Now that's amazing. Right now, just as I'm talking, now they're all gone. The buy imbalances, which is huge for the last hour, actually for the most part, just went to normal imbalances where they're not really sells, but they're down. And that's why the S&Ps just fell 2-3 points here right now as we speak. It's imbalanced data drives price on this day.
Wow. Well, yeah, gear up for some volatility today, guys. Of course, CC gave us a lot of great information regarding the triple witch options expiration. And I mean, markets, the S&P is down a little bit here. To your point, Dennis, kind of sold off here in the last. We're looking at the 2-minute chart here.
Still buying about. Wow, they're just sellers coming in here right now. I don't know what's going on. Now, I was just saying, there are huge buys when it started the sentence 2 minutes ago. Then they got cut in half. Then they went down to like neutral. Now some of them just actually flipped to sell. Like AT&T was showing like a million to buy. It's now showing 500,000 to sell. Crazy how they flip around like that. And they may flip back, but don't kid yourself. It's not a coincidence the S&P just sold off 3-4 points here right now. This is the reason.
Boom. Well, there you have it. All right, guys, it is 9:02. That will be a wrap for us today. That'll be a wrap for us this week. Thank you to everyone who tuned in to Benzinga's pre-market prep. We will have live trading starting up after this. And then other than that, we'll see you guys on Monday. Dennis, any big weekend plans?
Probably do some boating. This is like the end of the season for us up at Georgian Bay. My boat usually comes out first week of October, so you're trying to get it all in there. Last weekend we had just a fabulous weekend. It was 80 degrees. We were out at the islands on the beach. It was unbelievable. I don't know. It's supposed to be, could be a little bit of rain on Saturday, so maybe we get a day Sunday, but it's a little cooler. It's like 72. And the problem is the islands out there are in open Georgian Bay, so that water cools off quickly. You get these cool nights. Every week you go out there, it's like, ooh, it's 2 degrees cooler, that water. So you get in that water, it's not as nice. But yeah, try and do some boating.
There you go. Sounds fun. All right, guys, we'll be back on Monday. Hope everyone has a great weekend. Stay green today. Triple witch, some extra volatility. Should be a fun day. Buckle up, and we'll see you guys on Monday.